What's going on, everybody? Welcome back to another video here. So again, sorry for the little bit of darkness over here. It's like cold and rainy. The market's coming down. Powell's raising rates. A bunch of nonsense is going on. And we need to talk about the current situation of the market here because the things that are about to happen, you need to be aware of in order to correctly position yourself going forward, or at least be aware of the potential for pain that is about to come. Now, we've talked about this before. Retail investors are getting fucked. And it's not just the retail investors, it's everyday people in the United States, participants in the economy as a whole. And we're about to see something that we haven't seen in really the last 25 years. And this has to do with a concept called TINA that I've talked about a couple of times, but I want to make sure that you guys fully understand the implications of what's going to happen. So again, guys, before we go into all of that information that we have, if you wouldn't mind hitting that like button on this video here, helps out a whole lot with the algorithms. And again, Trade 1348 gang, make sure you guys comment down below what your favorite play of the day was here too. Late Night Fix is back as well. So make sure you guys hit that subscribe button and turn on that notification bell as well. Now, taking a quick look at the market today, looking at the SPY on the 4-hour time frame, especially after Powell here, it doesn't look great. Now, if we go back a little bit further, there are some key levels of interest that I want you guys to be looking out for. Looking at these levels right here, this key double bottom, we flashed down below it right here and then rallied all the way up to 431. This level at about 472.50, I think, is going to be defended very heavily by buyers. If we start to slip down below that level of 372.50, it's very likely that we are going to see new lows in the market. Now, again, you've had this cross down here. If you look at the SPY on this daily time frame, you see this cross down and you've seen nothing really but aggressive selling, besides that little bit of a pop back up as a little bit of a retest here. And again, I do want to highlight some of our members over here that have been absolutely killing it. Mike crushing it with a 6% day, Beer Barian with a 7% day over here. Again, with all of the tools that we have, guys, the live streams, the curriculum, the options data, the proprietary trading algorithms, the alert system, we are the best place to come and learn how to trade. So if you do want to take advantage of this volatile market, you guys know where to find us. Make sure you check out that link down below. But the first thing that we need to talk about here is a little bit on the housing market. So the Fed to reset the U.S. housing market through a difficult correction. Now, after the Fed raised interest rates, what we're going to see, or the Fed started to raise interest rates, you saw mortgage rates start to pick up as well. Now, coming over here, what we're going to see is mortgage rates rise to nearly 6.3%, the highest level since 2008. Now, when you look at mortgage rates and you try to think, well, what does this actually do to home prices? Higher mortgage rates means higher mortgage payments, meaning that you can no longer qualify for the same amount of a loan, meaning that the demand, not necessarily because people don't want to buy those homes, it's because they are not able to afford those types of homes anymore that they were previously essentially allowed to by these banking institutions, that they now no longer qualify. You see less demand and home prices will come down. That's the first thing. So we know that the value of homes are going to come down here. So going off of that, well, we know the equity market has not been doing well. Housing lags the equity market. We're also seeing the bond market start to freak out here too. Now, taking a look very quickly about what the expectations are going into the next Fed meeting over here, well, we've got a 71% chance of about a 75 basis point rate hike. Now, what does this tell us? The market is not essentially anticipating any slowdown in Jerome Powell and the Fed decreasing the rate at which we are raising our rates in the United States. So these rate increases are not going to slow down. So mortgage rates are going to continue to go up. Equities, stocks, are most likely going to continue to be volatile, most likely to the downside for the foreseeable future until we see us get this inflation problem actually under control. But if you don't know who Stanley Druckenmiller is, you should. When Stanley Druckenmiller opens his mouth, you listen. Legendary investor Stanley Druckenmiller warns that there is a high probability the market will be flat for an entire decade. He is one of the most successful fund managers of all time. After a hotter than expected inflation reading spooked investors on Tuesday, which was when the CPI data came out last week, the Dow Jones Industrial Average sank over 1,200 points, yada, yada, yada. That same day, Stanley Druckenmiller, one of Wall Street's most respected minds, argued that the pain won't be temporary and that stocks face an entire decade of sideways trading as the global economy goes through a tectonic shift. And we're going to talk about this shift in a second as well. And there's something that just nobody's talking about here that you guys need to understand. There's a high probability in my mind that the market at best is going to be kind of flat for 10 years. Sort of like this 66 to 82 time period, he said in an interview with Alex Karp, the CEO of Palantir. Druckenmiller added that with inflation raging, central banks raising rates, deglobalization taking hold, and the war in Ukraine dragging on, he believes the odds of a global recession are now the highest in decades. Now, we have that conflict over with Russia and Ukraine right now. We have the energy crisis in Europe. We have some interesting movement out of China and Taiwan as well. And we also have this inflation problem in the United States. Nothing is really looking good right now, and that is what we want to talk about for the remainder of this video here, and it has to do with this concept of TINA. TINA stands for there is no alternative. Equity markets have been powered higher by the TINA effect as yields have been unattractively low for years. Nominal and real yields have risen to potentially attractive levels due to the remarkable surge in inflation. The top priority for the Federal Reserve is to do what it takes to get inflation under control, even if it means pain to the economy. Pain for the economy will mean pain for equities as earnings are set to decline. Disinflation and recession will put the TINA effect into reverse, favoring bonds over equities. Because over the last basically 10, 20, 25 years, well, we haven't necessarily seen an attractive bond market. So meaning there is no alternative to equities. You're not going to put your money in bonds getting a very, very low rate when you could then go out, take the risk in the equity market and potentially return 10, 15, 20, 25% in a year. But we're starting to see that start to switch. When we look at the 10-year Treasury here, it is absolutely skyrocketing. This is the highest that it's been since back in 2011. Let me see if I can get this chart to refresh here. This is the highest that the 10-year Treasury yield has been since 2011. We go back here to this price level right here. 2010, 2011 is when we were at these levels for the 10-year Treasury. Now we look at the 2-year Treasury rate right here from about a year ago. Well, it was at 0.3%. Why would you put your money in something that's going to yield you 0.3%? Looking at the 3-month Treasury bill here too. Well, a year ago it was 0.05. Now it's 3.26. So now there's an alternative in the market here. So when you think about this whole situation with quote unquote TINA, there is no alternative. What I like to do with the bond market a lot of the time is look at the flow of money. You can look at the bond market and the fluctuations between yields and the actual values of these bonds and the flow of money into the equity market as a view of where investors are looking to place their money. Now, the bond market is going to be a little bit more tricky to read because if you see investors selling bonds like this, well, rates are going to go up. These yields on these treasuries will go up. But that doesn't necessarily mean that there isn't a super high amount of demand for these bonds right now because you're seeing the equity market start to come down as well. So there's a flight to cash and big money investors are trying to figure out what to do. Now, if they then decide with that large cash position to allocate more money into the bond market than they were in years prior, that takes more demand out of the equity market, the stock market, meaning that it's going to be a lot more difficult for stocks to continue to go higher. Now, these yields and these rates that we are seeing here with the Fed continuing to raise rates and showing really no sign of slowing down, well, it's not really going to stop. You're going to continue to see these situations with these yields starting to tick up. We could go to, on the 10-year, we could end up at, let's see, 4%, 4.5%, which would be really, really crazy and something that we haven't seen in many years. So how does this affect everyday retail investors? Well, when you think about the bond market, the stock market, the real estate market, and what's happening with Powell right now, they've really switched to a single mandate of getting inflation under control. They're looking at the labor market data, the unemployment rate, but they don't necessarily see that as being a large problem yet. So they're going to continue to do what they're doing in terms of raising rates until they see what they need to, inflation coming down. Now, when is that going to happen? Well, the credibility right now that the public has in the Fed to actually accomplish this goal is relatively low. Remember, inflation was not a problem, then it was transitory, then it was here to stay, then it's fine, then it's blah, blah, blah. Every single time that the Fed has opened their mouth and made a significant statement, it's been wrong over the last year and a half. So now they have a few options. They're going to keep raising rates. They're going to keep running off the balance sheet and try to get things under control. But this is not good for the everyday person. Your home price is going down. It's harder to get loans in general. You're going to see the overall growth of the economy slow down, and you're also going to see the unemployment rate tick up as well. Well, that's not good. If you already see high prices and people start to get laid off, they don't have any more money to spend on goods. So you push this whole system into a situation where if they push it too far with rates, they are going to need to do something drastic. And like we were talking about in the live stream last night, you could see the market really start to flash around and become incredibly volatile. Now, what does that also do? Thinking about Tina there, if you're going to see incredible volatility in the markets, you can go in and lock in your rate in a Treasury bill. So we are at sort of a turning point right now with the market that you guys need to understand that if these rates continue to go higher, they become a lot more attractive for large institutional investors. Now, this whole system is essentially revolving in a circle right now. Fed raises rates, unemployment goes up, everything becomes more difficult for growth. You start to see more unemployment. It's not a very good situation to be in. So we really haven't seen that light at the end of the tunnel yet from the Fed. Now, over the next couple of meetings, let's see how some of this data actually comes out, but things aren't looking great right now. And at the end of the day, it's going to come down to, well, one, how much risk are you willing to take in this market right now? And do you have the tools to navigate this market and make money short term in order to set yourself up in the best way possible to maybe buy some long-term investments or put some money in your pocket from the market every single day. So guys, that is going to wrap up this video here. If you did enjoy the information and analysis that I provided for you guys here, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people who want to learn. And if you guys do want to see more videos like this, make sure you hit that subscribe button and turn on that notification bell so you're notified every time I post a new video. So hope you guys are having a great evening. See you guys in the next one. Peace.